Is a loosening job market and an ongoing retreat in inflation leading toward the soft economic landing that the bulls have pinned their hopes on all year? Or are the economy and market headed for harder times? To debate this, we'll bring in Tom Lee, Fundstrat Global Advisors co-founder and a CNBC contributor right here at Post 9, as well as Warren Pies, co-founder of 314 Research. Guys, great to see you both. Appreciate you joining in the home stretch of the week toward the weekend. Tom, I think I frame it as a debate because the numbers are definitely encouraging in that Goldilocks manner, not too hot, not too cold. You are seeing inflation move the right way. You are seeing the labor market soften up but not fall apart. On the other hand, none of it's inconsistent with either sticky inflation or we're headed toward some kind of an economic downturn. So where does that leave the market entering the new month?
Well, I think you've definitely described why investors are bifurcated. You know, there's folks who see hawkish things and bearish things, and they stay bearish into this September. And on the other hand, I do think there's a lot of evidence of the soft landing and that inflation's on a glide path much lower. And given how hesitant people have been and how much cash is on the sidelines, I think that resolves positively. But the reason I would sort of emphasize that view is I think companies have been really managing this exceptionally well. I mean, energy second quarter earnings were up 3.5% year over year. I mean, the earnings recession has ended, so we're in a profit recovery cycle as well.
No doubt about it. We've seen an upturn in the forward estimates for the S&P 500 earnings. Although part of the August story, when we got this shakeout, we got this 5 or 6% pullback. You definitely saw sentiment cool off. But part of it was a rate scare in the sense of long-term bond yields going up to levels which at least recently have been uncomfortable. Are we out of the woods on that front? How do you interpret the way the stock market has tried to digest that?
I think it's two ways. And again, this is where it's indecisive because what we're seeing is a bear steepener, which it's actually generally good for stocks because it's reflationary. But we know when, like today, yields popped. Yields were higher today on a soft jobs report. We know that hurts tech stocks. So I think markets are reflexively still reacting to higher rates, and rates are unpredictable. So I would have liked to have seen rates fall, long-term rates, but they're up today.
Sure. And Warren, in terms of not really just the rate story, but even the internals of the jobs report, the general run of economic data, which has somewhat cooled off, what does that tell you in terms of where we might be going, what the market has seemed to price in from here?
Yeah, I mean, I think that at this point, it's clear to everybody that we're getting to the late cycle. So even just a few months ago, there was a kind of an open debate. Where are we in the cycle? And at this point in time, we're starting to decelerate, and that's pretty clear. Obviously, we're creating fewer jobs. The revisions are getting worse. I mean, that's something you see around recessions or into slowdowns where you get negative revisions month over month. We've had that through the beginning part of this year. Something we look at is residential construction payrolls. Those continue to decline, and you're getting negative revisions there too. So all of these things point to a late cycle type of environment. And then, as Tom's alluding to, you kind of have to ask yourself, are we going to end up with a soft landing or a hard landing? And that's a tough question to answer because I think at this stage of the cycle, both of those outcomes feel the same. You start decelerating on the data. You start having a softening of the labor market, the very first signs of softening. And it could go either way. The odds historically are that we're going to end up in a hard landing. Soft landings are really rare. The bear steepener, I agree with Tom. We just had a bear steepener, but when you get a bear steepener out of an inverted yield curve, that's usually before you enter a recession. And the most important thing here is not predicting the right outcome. It's understanding what's priced into various markets. And I would argue that you're not being paid to bet on a soft landing anymore, that right now markets in general are already pricing that in. So if we get that outcome, you're going to have to look ahead and say, okay, what's next? I think that under a hard landing is actually kind of underpriced at this point in time. So, I think we all agree kind of on the lay of the land and the weakening of the data. It's just a matter of what's priced in the markets here.